I see an incredibly dangerous market where growth, the growth engine, right? This is how we grow. We got to grow earnings. You got to grow the markets. That's how you get higher multiples, right? We have the growth has been taken off the table. Okay, first with the Fed no longer keeping rates historically low, which we know. Again, I'm repeating this. I'm not going to tell you anything new for now. I'm going to get to a lot of good details in a minute, which no one's really talking about. But instead of buying bonds, which is QE, quantitative easing, they're selling bonds, right? QT, or shrinking the balance sheet, which removes liquidity from the market. They're going to be selling hundreds of billions in treasuries, and to be technically correct, or letting them mature either way, but removing hundreds of billions of dollars off its balance sheet every quarter for probably another 6 to 8 quarters. Okay, you have this drag on the market. It's like you have, this rope around your chest and you're trying to run, and it keeps pulling you back, keeps pulling you back, keeps pulling you back. Where at the end, you had someone when it was QE and low interest rates, every time you slowed up, you had two hands behind you pushing you forward to make sure you could still go forward, right? You used to buy stocks no matter what. They go down, who cares? Bad earnings are going to come back. Low interest rates, money's for free. It's a different market. So let's get back to growth, right? First with the Fed. That's removed now. They got to control inflation and no longer injecting money into the market. That's massive, massive, massive. Second, with China. China was also the main growth driver of the markets for decades. And people forget, China was growing in excess of 6% for basically 20 years plus. Dating back to 2000. Sometimes 9, I think it actually had double-digit growth, but over 6% every year, dating back to 2000, pre-COVID. However, China is only expected to grow, 3% next year? Some economists see 4%. That's the big discount compared to 6%. But the 3 to 4%, this is what I have a problem with. Okay, one, it's still well below that 20-year average. But two, how is China going to grow that 3 to 4%? I want you to think about this for a minute. Because where do they see most of their growth from? The U.S. is expected to go into a recession this year with demands falling off a cliff due to much higher rates. I don't know if you saw the growth that's expected quarter after quarter, but I think it's like 0.2%, 0.1%, and then a negative and 0.1%. That's 4 quarters. We're not talking about 1%, 3%, minus 4%. No, this is like steady, very, very slow growth every single quarter for 2023. There's a shot that we can go 4 straight quarters of negative GDP. It's very, very likely that we could do that. And we're looking at, on average, a 0.2% growth per quarter over the next 4 quarters. That's what the economists are predicting. Now, the U.S. accounts for 20% of China's exports, not to mention that we're also doing everything in our power to be less reliant on China, right? We're moving investments, opening up new factories and fab plants in other Asian regions and in the U.S., trying to do less with China. How the hell is China going to grow that much when you're taking their biggest growth driver is going into a recession? Yes, they're opening, but it's not like it's going to be this massive 6%, even 3-4% growth. This is a super older population that's scared to death. They have bodies piling up like crazy, which is the saddest thing in the world because we know COVID is for real when it comes to older people. Especially older people that have underlying conditions. There's nobody that doubts that. What we doubt is forcing this freaking needle and shots and everything else down the throats of children or people who really don't need it, which we now know was all bullshit. And the booster shots and the amount of profits that Pfizer make now finally admitted that, it doesn't really, it doesn't prevent COVID. Right? You didn't tell us that, right? You lied to us. It's okay though. You've been in bed with the FDA for a long time. That's why you got fined so many different times. You have the leader, right? Someone who's basically on the board of directors of Pfizer, who's the main person that we're listened to, which is Gottlieb, right? If that's not the biggest bias ever, that's freaking crazy. Now we know a lot of this bullshit. However, in China, COVID is very, very serious. Bodies are piling up. This impacts a lot of their population because this is a much, much older population. They're not just going to run out and go to work and everyone's going to be fine. They're seeing this. It's like September 11th when that happened. Everyone's like, where were you? Where were you? Remember when they shut down all the airlines and, again, all the flights were grounded and they did it for a couple of days. When they opened up, people, even myself, were looking outside. You were thinking like an airplane's going to crash into something near you. That's how scared you were. That's how you're thinking. That's your mind going, holy shit, when something dramatic happens. These people are seeing their grandparents, parents dying from COVID. They're not going to run out really quick. It's very, very scary over there. But I don't see China growing 3 to 4% when you're taking out their main growth driver, which is the U.S., which is going to go in a recession, and has announced their intentions to lower their investments in China, which we're doing right now. So I don't see China becoming a major driver for U.S. growth for a long time, and that's what's driving this market. In the meantime, what do we see? The Fed just raised rates, continues to raise rates, fastest pace since the Fed ever, and maybe believe, hey, you know what? The Fed's close to done. They're close to done, the Fed. You got a couple of more hikes until March, terminal rate at 5, maybe 5.25. I got to say, really? Because I'm a person, you have to look at the data, right? And I'm someone that looks at the data constantly. And I'm going to share something which I'm not seeing being shared anyplace else, really. I'm not saying that as this whole, so you pay attention more. Just listen. Listen to what I'm saying here. It's very, very important. Because I'm going to make a bold prediction that we may see another 50 basis point hike in the future, this year, or a lot more 25 basis point hikes than are projected. I'm talking about through the second quarter and maybe into the third quarter, which nobody is predicting. We're looking at March, maybe April, some of them, looking at a 5.5% terminal rate, we could be well over 6%. You say, Frank, that's crazy. Hear me out. Hear me out first before you start yelling and cursing at me. You look at the Fed, they said they're not going to pause until they assure inflation's under control, and we're near its historical 2% rate. Right? And one thing's for certain, over the past 8-9 months, you got to believe the Fed. They did everything that they said they were going to do. Whether you agree with it or not, whether you hate the Fed or whatever, exactly to a T, they've been doing everything. I told you they're going to raise aggressively. You knew the rate hike. Like, there's no surprises. There has been no surprises in terms of rate hikes. There's surprises in how they're speaking, and sometimes it's getting misinterpreted, and that could be their fault. But every single hike, it's predicted, right on the button, and this is what they've been doing. They said, okay, we're going to slow the rate of these hikes, or the percentage, which they did. They're still raising, but they slowed to 25 basis points, and that's what they said they're going to do. Now, they want to get that rate closer to 2%, which is going to be very difficult. So as much as everything's trending in the right direction, CPI is still at 6% right now, which is insane. If it didn't go to 9, 10%, and it was at 6%, we'd be in panic mode right now. But since we saw 9%, now it's 6%, we're like, wow, it's trending in the right direction, so everything's fine. You're right. Okay, and even when you look at other things, things are declining, retail sales have pulled back, even the PPI, most inflation gauges have showed that we're moderating. But let's look at the present. Have you seen what gasoline prices are right now? They're up 20% from the November lows. So the average price right now is $3.60. We have to look at everything pre-COVID, of where the market was pre-COVID. Because after COVID, everything was crazy. We saw 1 month of a decline in the markets before the Fed said, hey, let's just keep printing as much money as we can. It doesn't matter. It's not a limit. There's no accountability. Let's keep going. 1 trillion, 3 trillion, 7 trillion. They got to $11.5 trillion. Now we're removing all that liquidity from the markets. That's why everyone's laying off, seeing slow demand, much higher rates. So we have to go to a pre-COVID market, right? Let's eliminate COVID, because that's a good comparison, because that's where we're going to be, removing this liquidity. So we look at gasoline prices on $3.60 on average, right? So pre-COVID, that's the highest gasoline prices have averaged. And I went back on an annual basis pre-1993 at $3.60. So I know the guys in Washington are going to be like, they were $5 at $3.60. You guys could afford it. It's not a big, it's $3.60. Do you see them going lower? I don't know. It's nice when you have this massive strategic oil reserve that you just, unloading, and now you're going to have to replenish it. But it's interesting because now oil prices are going up over $80 a barrel again. Let's go back to pre-COVID. I know we saw over $100 a barrel. COVID, oh my God, we saw 0 and over 100 in like a year and a half, right, for oil with the futures. But pre-COVID, the last time we averaged $70 a barrel was 2013. So you go from 2013 into, the end of 2019, beginning of 2020, oil prices, they never even got above $70, the average. We're over 80 right now. Have you seen what copper prices are? They surged. They're 420. It was 320 in July. 8-month highs. Remember that crash in used cars? Used cars are full. They're crashing. We've never seen anything great. Everything's working. That's 6 straight months of declines. Well, let's look at the present. According to the Manheim Used Vehicle Index, okay, this is the most accurately, widely used gauge in this industry when it comes to used cars. Used cars increased by 1.5% for the first half, at least the price, first half of January, which currently marks the second month in a row that used vehicle prices are rising. Did you know that? Did you know used vehicle prices have been rising the last 2 months? Did you see what copper prices are? Do you see what natural gas prices are? The Fed's trying to control inflation right now. We're looking at a market that's surging, which is giving them okay to continue. But now you see inflation start to come back. Have you seen food prices? Look at the dining index. This is according to Open Table, that seated index, which a lot of people use. I'm not just picking out components. This is what people base this stuff on. Most popular gauges. Right? So you're looking at the Open Table seated index with dining, and dining is starting to surge again. The prices. Also, supermarket prices are starting to surge again. So you're looking at food prices going up, oil prices going up, energy prices going up, copper going up. Remember, rent's coming down? That was a big thing. Rent's coming down. It's the biggest component. Jeremy Siegel, well, we're looking at real-time data, and rents are coming down if you're looking at real-time data. I want to see what he says next time he's on TV. Because Zillow Rent Index, again, another measure that people that, widely use gauge. The Zillow Rent Index rose in December. And this is falling off its highs from July, where we saw, again, trending in the right direction. We're no longer trending in the right direction. And then we have the wonderful stock market with the most risky assets, which includes the NASDAQ. NASDAQ's up 8% this year. Those heavily shorted names are up tremendously. And what do you think the Fed's going to do? The Fed can't say, hey, the next meeting, where's the CPI going to be? All these things are broken out. You may see energy, energy is going to be higher. Food prices are going to be higher. Maybe you see rentals, again, they should be higher. Maybe, again, it's back-looking data, so maybe you're going to see it lower. But what the Fed is seeing right now is not an indication that they're going to stop anytime soon. They can't. Because inflation is not just, it moderates. It's going up sharply. Sharply. So now we have an insight. Why is that happening? If you want to look at what all this is related to, it's related to one thing. It's the dollar. The dollar's falling. That's why gold's going higher. That's why stocks going higher. Everything's good. But when the dollar falls, inflation goes through the roof again. So this is a double-edged sword that the Fed has. There's no easy solution here. Either the Fed's going to keep raising because we're seeing this inflation surge, or we're going to see the markets come down tremendously and everything come down and really, really crash from here. Because that's what the Fed needs to see. Because we have no growth going forward, yet stock prices are going higher.